Okay, guys, welcome to the SMB show. This is number one place to find out what's going on in the space. Today we have a guest joining us, and our guest is John Noble, who's an accountant and a tax expert. So welcome, John.
Thank you for having me.
I appreciate it. It's been a long time coming. I know we've been connected for quite some time on social, so it's definitely overdue. So I think a good place to start is if you could just tell us a little bit about you and what business you run, and yeah, just a bit about your background, really.
Okay, so my name's John Noble, or King Nobes if you follow me on socials. I founded Noble One Accountants, so we're a property tax specialist firm, and we show people how to start their business, scale it, and invest those profits tax efficiently into cash flowing assets to live the life that you want to live on your terms with cash flow that's not linked to your time.
Oh yeah, and without a doubt, planning's always been very important, but I think for small business owners, it tends to get overlooked until they think they need it, right? So I think that probably a good place to start would be for those that are in a position where their business actually makes profit. What's some of the things that you're advising your clients to do when it comes to extraction of profits from their business at the moment?
So one of the key things is structure. There's different points in a business's lifetime. So if you're just getting started and you're dipping your toe and you don't have experience yet, you don't need to overcomplicate anything. A limited company is crucial for many tax reasons, but also the liability aspect. But if you have a company that already has retained earnings, you've got staff, you've got management, you want to be looking at holding companies and removing the risk from your business. Business is risky. Trading businesses are risky, but they can be less risky if you have really good planning and you know what you're doing with your cash. We come across a lot of people who they started their business, they didn't expect it to get as successful as it is currently, but they've got a single limited company, they've got a single shareholder, they've got 500 grand in the bank, and the only way to get that out is to pay themselves personally, which isn't tax efficient because the UK penalizes ambition. The more you do, the more you earn, the more tax you pay. It's a tough tax landscape to grow a business. Great for starting it because we've got lots of people here, but to grow and develop, it's tough. So you need to almost reverse engineer what your goal is. And of course, your goal will change over time. As business owners, entrepreneurs, we're never satiated. So we say, once we get to this point, we'll be happy and we'll slow down. We get to that point, nothing changes, we don't celebrate, and then we move the goalpost a little bit further. But if we can preempt that by spending time with people who maybe have done what you're trying to do, then you can work backwards. And risk is the key thing. You don't want to build a business 5 years, 7 years, 10 years, and then have to start again. So what I say to people is, your goal, simple goal, is to avoid catastrophes, avoid having to completely reset. And this is why I like property. There's many other asset classes, but you want to take a risk in your business, make money, keep as much of that money as possible tax efficiently, and then transfer that into long-term, and that's the key thing here, it's long-term assets that go up in value. Could be businesses, property, gold. There's other speculative assets, but we want to take the risk in the business and then move it into safe assets. And then just repeat the process. And then in the same way that when you play a PlayStation game, when you're younger, of course, we don't have time anymore, you get to a certain point and you save, and then you can reevaluate. A lot of business owners are going through this business life plan that they have, but they never have that point to reevaluate. They're always firefighting. So you want to have the save point, and structure is so key for that, because a simple holding company that owns the shares to your trading businesses allows you to extract profits, extract properties, IP, and then it's away from your trading business, which means if something were to happen to that trading business, you can move on with all of that cash, assets, property. So that's the key thing. You want to work backwards.
No, 100%. There's a few things there. The first one is to get to the position where you're making profits, to be fortunate enough to start planning, start reinvesting, etc., and looking at different ways to extract those profits. Up until that stage, what are you seeing at the moment with some of your clients with whether that's cash flow constraints or any struggles at the moment in the current environment? What are you seeing more so than you used to?
Yeah, it's getting tougher and tougher because the cost of running a business, people have this illusion that if you're a business owner, you're a multimillionaire. Most business owners work in their business. They don't have a business, they have a full-time job. If they were to step away or replace themselves with somebody of a similar caliber, well, it's not a business. VAT, it's a turnover tax. It penalizes you. So what a lot of businesses are doing, they're getting to £90,000 and maybe they're stopping and saying, I'm not going to grow this business. And they may evaluate, okay, I can be on the flat rate scheme, so we can go up to 230,000 in turnover, not profit. And then if they were to register for the standard scheme, they're no longer profitable. Hiring people has become a lot more expensive. The risk involved with all of like the shipping costs, oil, getting your product to yourself, subscription costs if you're running a service business, the reward is becoming less and less. And of course, there's an equilibrium because if less people are getting involved, there's more opportunity. But for the person who's just getting started and maybe they have quit their job or their ambition is to quit their job and replace their income, it's getting harder and harder. And they are the young entrepreneurs that will grow and build businesses and contribute to the country by employing 5,000 people maybe in 20 years' time. But by not allowing them, the government this is, and the councils, by not allowing the businesses to get to that point where they're essentially at critical mass where they can just keep growing and keep contributing more tax revenue, more national insurance, more VAT to the country, everybody's losing out. So when I've had businesses for 15 years. It was so much easier a decade ago, so much easier. You could almost trial a business, and if it didn't work, you'll trial another business. Now you need to put all of your eggs in one basket with that trading business and sell your time initially so you don't have to take on these other costs, such as bringing in management, bringing in people. So it's getting harder.
Yeah. On that, when it comes to penalizing entrepreneurship and people taking risk, where do you think the disconnect is between the general public and business owners? Because in the UK, an SME, I think the average revenue is around 300 grand, and online, I'm sure I read something around 23-24% profit margin. I think that's pretty good in the current environment, right? Margins are becoming very much compressed. Now, of course, profit and cash are two different things, but if you just take that bottom line figure there, in the current tax environment, it's hard for someone to not think that it's a little bit unfair on business owners that's taking that risk. Because if you look at then the average salary, I know it depends on where you're at, but was around 40 grand a year now, probably. They or thereabouts for those that are fortunate enough to get a job and find the position that they're in. But like 95% of the businesses, of those like 6 million SMEs in the UK, most of them are micro businesses. Probably 3/4 of them have no employees whatsoever. So if you think about the people that have got to a situation where they are employing people, they have taken on that risk, you think that there'd be more incentives for those people to boost productivity. Productivity in the UK at the moment is one of the lowest in the G7. So if productivity is very low, the macro environment looks quite bleak. Why then you would go and penalize the people that are still out there taking risks or took a risk before? Because I think that the disconnect starts at, like you just said, they think everyone that owns a business is a multimillionaire and they got it easy, right? Now, surely if the tax environment was a little bit more favorable for those taking risks, most of us, you mentioned at the start there that the goalposts move and you want to go to the next thing. It's natural for an entrepreneur to think, wow, I've achieved something. This thing that I took a risk on worked out. What's next? So the problem is with this in the current environment, as you get to that situation, but it's a constant battle, it becomes difficult. Whereas if there's incentives for those people, they will continue to go, and they're more likely, 9 times out of 10, going to reinvest back into the business, which goes straight into the economy, which employs more people and boosts productivity. So where do you think the disconnect is from the general public, it's that sort of the lack of education around it and the reality of it? Where do you think the disconnect is from general public to the politicians to business owners? Where do you think that disconnect is?
It trickles down, of course. And something I'm conscious of is we think as humans that people know what we know. So you and I are speaking about this because we're involved in it. I don't think, and I hope that the politicians and government are unaware, because if they are aware, then it doesn't make any sense. We need business owners, because the country is essentially a business. It's run as a business. And we do not have business owners running the country. We have politicians. And without getting into the fact that we have new politicians every few years, and then there's elections, and then everybody gets replaced, and there's a new ideology. So it's impossible to actually have compounding growth towards one goal, such as prosperity for the entire country. Assuming everybody's got the country's best intentions at heart, you need to put business owners, key business owners, in government, even if they're advising, but they need to have their finger on the pulse of what's going on with the politicians so they can advise. Currently, what we have is all of those potential people who could help leaving. And why would you stay? Once you've made money in a country that you grew up in and you love and your family are here, and then all of a sudden you're getting penalized, you want to sell a business and the tax is extortionate. You want to scale up and add another 200 employees, but you look at the numbers and you think, why would I take the additional risk for a minor gain? Because it's diminishing returns as you scale up a business. You take on more debt, more leverage. You might need private equity, all of these things. Why do it when you can jump on a plane and actually be in a place where, and this is really sad because I love the UK, but it's really easy to leave and all of a sudden feel appreciated. Yeah. Business owners take risk. We don't have to do this. I do think sometimes there's a bit of an entrepreneurial curse where it's most of the time it's not fun. And I think your level of success is correlated with your level of stress you can endure. But most people wouldn't take it as far as some people have taken it. And these ultra successful entrepreneurs look around and they think, well, this isn't the place for me and my future family. It's usually about the future family. At a certain point of assets value or a business's value, you would lose it if you died. We all die. And then people start thinking about inheritance tax and things like that. And they think, okay, well, logically, my heart wants me to stay, but logically I need to leave. So from a government perspective, they need to bring in people who understand business. And I do think employees are unaware because business owners aren't looked upon as that's something I want to do. When you go to school, it's I'm going to be a biologist, a teacher, a nurse. There's no lesson where it says, oh, let's go. We've got a double period of entrepreneurship. I remember I used to sell things at school and I got in trouble. I was buying things outside of the gate and then you'd go in and the gate would close and you think, okay, this market's closed now. I can charge not whatever I want. It was reasonable. And then you get penalized by the teachers when that is actually a skill set that should be taught in school so it can proliferate. And then you get these young business owners, women, men, go out, create economic value. That's the key thing. They're creating new economic value that wasn't there, which creates revenues for the UK. And a lot of these businesses will be taking money from lots of different countries. They might be invoicing Germany and Dubai and Russia and all of these places. So then you're taking in income from other countries as well. For me, that seems like common sense, but it doesn't happen. And I like to only focus on what I can control. And we have no control over any of that.
Yeah, no, I totally agree. And as you mentioned there, I think that the fact that, a lot of the people that have left the UK is not because they hate the UK. It's because things changed. And to get to a point where people decide to leave because of the way the economy has changed or the environment's changed in whatever way, or you feel like you're being penalized or whatever that may be, I find it crazy that they've allowed that to happen. Because you see the, YouTube channels, I forget his name, Andrew Henderson, I think it is, the nomad capitalist guy. He's been talking about this for years, right? Go where you're treated best, etc. And I think that it's such a big move for people to be like, I'm going to jump on a plane and go and live in another country. You become, it's quite tribal when you grow up in an area and you're like, I'm going to actually leave, so it's such a big decision. And the fact that I don't know what this whole mass exodus is and how many people's actually left, because I don't know where the real data is coming from, but a lot of people has left. So people decide to make a massive life-changing decision, and most of the time is because of the way things are at the moment. So, at some point, rather than looking at, I did see a clip of Zach Polanski saying about how we need to focus on these 154 billionaires and start taxing them more, etc. And Daniel Priestley commented underneath, and he was like, we need to start focusing on 150 people and start focusing on the 1.3 trillion of government spending. So I think that because the media doesn't help, right? Even what's going on currently over here, the media is definitely not helping in regards to what's actually happened versus what's being said. But it's such a shame that this has started to happen, that so many people have left. There's people that have left that love the UK. They would never ever even consider leaving, and they've left, and it speaks volumes. I suppose off the back of what we're talking about, before we get into some of the questions around your business, etc., because this is quite a hot topic at the moment. But with the UK economy as it is at the moment, it is facing weak growth. We're not in the greatest position at the moment. There's, as you feel like there's becoming again a grip on inflation, which is arguable, but now it feels like there's going to be some inflation pressure again. Mm-hmm. And we still have. I know they held the base rate yesterday, but where a lot of people was anticipating, especially towards the back end of this year, that coming down quite substantially from where it was. Right now they've held, which is totally understandable because of where things are at. But what are you seeing yourself, and what are you sort of forecasting in a quite unstable inflation rate environment at the moment? What are you seeing over the next 12 to 24 months based on yourself and what the business owners that you're speaking to as clients and friends?
Yeah, of course. So we were on a very good trajectory. Since 2022, everything was inflation was reducing, the base rate was reducing. We are linked inherently to the USA. And we do not know where currently we're 3 weeks into, I don't know if it's classed as a war, but a conflict. And the key element is oil and gas and energy, because absolutely everything needs to be transported. So it increases the cost of every product on a ship, a truck, a car. That will have inflationary effects. It will do. So there's two things I'm thinking about here. You need inflation hedges. So you need assets and vehicles that not are immune, but will ride the wave of inflation. And also you need to evaluate your leverage. So we're big in property. We work with lots of property investors. So what we're saying to people now is consider, if you were thinking potentially you wanted a 30% loan to value or 40 or 50, give yourself more of a buffer until we know what is going on. We are the Bank of England and the Fed. If the Fed reduce rates, typically we follow suit. Okay. And there's so much turmoil in the USA at the moment, it's impossible to predict. So it's time to be cautious, but don't stop, because time, and not to be too philosophical, but we only have a certain amount of investment seasons with us. So you still need to be taking action. Cash in the bank is going to be eroded regardless through inflation. Cash is an asset to be used. It needs to be moving around. It needs to be going into business, into property, in and out of assets, whatever you are comfortable investing in, but you can't be stagnant, but you need to be cautious until we know what's going on. Because as soon as there's uncertainty, all of the big lenders start pulling their rates. They start adding on a percentage or two just to cover themselves. So you don't want to jump into any long-term lending this month. Everything may be much better next month, but we do not know. But you need to make sure you're not over leveraged, or use this as an opportunity to put in very, very cheeky offers on businesses, property, knowing that people who are selling might be panic selling, which they most certainly will be.
Yeah, without a doubt. I think the sentiment changes very quickly now more than ever, just because of social media and how fast that information gets passed around. You see the fear in the news. Yeah. People think it's doomsday, and because it's so quick, if you look back 10 years ago, and obviously social media was around, but people are still getting their news and information from other places, whether it may be newspapers or subscription sites or whatever. Whereas now you open X or you open Instagram, the fee is in front of you. So people get scared very quickly. I see it here. People are like, yeah, the market's down 60%, blah, blah, blah. It happens all the time. And, I remember listening to a podcast. It was Howard Marks. Dalio was talking about Howard Marks, and he was saying that in times of turmoil, he said, you'd ask Howard, what are you doing? Are you being cautious? And he's like, yeah, cautiously invested. So, Dalio was like, they're still invested, but they are taking a little bit more caution towards those investments. But the key point there is they're invested. Yeah. So as you just said, I think it's important to evaluate what's going on. Definitely look at your personal situation to start with, and de-risk as much as you possibly can. On the HMRC side of things, HMRC and sort of compliance in general is tightening and squeezing SMEs. Just a quick one from yourself. What are some of the most common, compliance mistakes that you're seeing happening at the moment, especially over the past 12 to 24 months where we've seen a few changes?
Sure. Since Labour have become our leaders of our country, they've done a lot of surreptitious moves which aren't in the media. So the penalties for absolutely everything have doubled now. So a late filing penalty was 100, now it's 200. The interest has gone up. They are trying to extract as much cash from business owners as possible without putting it in the headlines. So they said they would not raise tax on working people. So they kept standard income tax the same. Dividend taxes went up. Property income tax in your own name went up. Every single opportunity to extract more cash from working people, in my opinion, they have utilized. They have employed tens of thousands of additional workers to look through things. We've been involved in tax and accounts and property for years now. And I would just from our client base, I would say we're seeing 5 to 6 times the amount of, not inquiries, because we don't get inquiries because nobody does anything wrong, but just phishing letters, trying to scare people into giving over information. And there being less, you used to be able to clear lots of penalties if there was a minor error from the client. You can't really do that anymore. They're really looking at every way to extract cash without making themselves seem as if they're doing it in the media. That's one of the key things. Property, because we're on property, you really cannot be purchasing property in your own name anymore. Yeah. At every single, you should be able to expense your costs. Okay. And as a property investor, your mortgage interest is usually your biggest cost. That's not an allowable expense in your own name.
Which is crazy, right?
That is actually crazy. If you went to any other business and said, okay, here's your business model, what is your biggest cost? We're going to disallow that. There would be uproar. But because everybody demonizes investors, they think, yeah, take that money back and give it to us. But the money doesn't go back to where you want it to go. It's just crazy. So you need a corporate wrapper for business and property. You need good structuring. What you don't want to be doing is paying corporation tax and then paying all of the personal tax. Personal tax is optional with a holding company. So you can strategically pay yourself salaries that are tax efficient, dividends that are tax efficient, adding family members as shareholders to use their basic rate band, changing the dividend rights to shares. So if somebody has 30 grand and somebody has 5 grand of income, you can pay yourselves strategic dividends to bring yourselves up to £100,000 between you. If there's 2 of you, if there's 3 of you, 150,000, and you want to keep all of that excess cash and retained earnings in your corporate ecosystem and do not leave it there idle. You're only getting maybe 3% interest on your savings in your bank. You need to be thinking about where you're going to be investing that: business, property, gold, in safe indexes, ETF funds. But you want a return from your capital, because that's how you escape the time element of selling your time and working really hard. Your money needs to be working for you, and you need to be working for you, and your everything needs to be working for you. But if you're working really hard and you've got lots of success in the bank and it's sitting there, it doesn't appear like it's rotting and eroding, but it is, because in 5 years' time, when you go to buy something, that car, that house, that iPhone has gone up by 20%, but you're unconscious. You need to understand this. Everybody does.
Yeah. And I made a bit of a joke video. I was serious, but I made a bit of a joke about HMRC Connect and how they should use that amazing software that scrutinizes small business owners and figures out, are you living beyond your means, etc., and use it for government spending if it's that good, right? Because we'd be able to work, we'd save. Can you imagine if they, instead of focusing on all those micro businesses in the UK, they're like, let's just see what we're doing wrong here. They'd free up a hell of a lot more cash. And I do feel that they definitely smell blood at the moment. If you look at some of the things they're focused on, R&D claims have been heavily scrutinized, which I get, because I know there's been a lot of misuse of R&D claims as well. I know there's misuse of directors' loan accounts as well. But again, I feel like they're really diving into everything. Dividend versus salary structures, you've mentioned that just a second ago. And yeah, I just feel that, also another one was the calculation of thresholds of associated companies as well. I've seen there's an article about that recently as well. VAT errors, they're all over the VAT. And look, all of these things, I get it, right? As a business owner, we should be held accountable, for the way we operate, and we have to operate within the rules. But when you see things like HMRC themselves has failed an external audit for many years on the bounce, and that's an external audit, it's the National Audit Office that actually do it. They fail audits, or I know they call them qualified opinions, but it's technically a failed audit. And I just feel like, it just doesn't make sense for the way they're putting their focus. They're focusing on, at the end of the day, we're the life and blood of the economy. We employ like 60% of the workforce in the private sector, business owners. So if you're going to keep killing those and they move to a different jurisdiction, or they decide they've had enough, and you probably speak to business owners all the time, right? And I speak to some, they're just like, I'm going to shut the doors. And these are like 4-decade-old companies that do employ 50, 60, 70 staff. And then you start to talk to them about, look, there's other ways to do this. But they're like, I've literally had enough. They're like, we went into COVID, and COVID was like a double-edged sword, right? Because some business owners just couldn't survive, and some accelerated and like a rocket ship out of it, and they've had their best years ever, right? But regardless, the uncertainty came in for business owners, regardless of which way you went. So they've gone through this, and they've gone through all the other, concerns and things that have come up over the past couple of years. And then this keeps happening. At some point, if you're 70 years old, you're going to be like, I don't even need to do this anymore. So, and rather than having a succession plan, because a lot of them don't, let's be honest. If they don't find a buyer, or they even consider buying, or someone doesn't reach out to them and they don't have children that want it, a lot of them do go through the process of shutting it down, or just giving it to the management team that a lot of the time aren't fully capable of ownership, So it's such a frustrating time at the moment where people do feel like they're getting penalized. And are you telling some of your clients, like, what's the conversations with you and your clients from say 2022 to today? Like, what's the biggest changes that you're having with them?
There is a massive transfer of wealth. Okay. Massive. There's lots of old landlords and old business owners. And I say old, I mean, they might have done it for 20 or 30 or 40 years. They don't realize the value. And it's not I have these conversations with people, like we're having a conversation, but usually when somebody reaches out to me to say, I'm closing the business, they've made their decision. They may have thought about it for 4 or 5 years, and they've got that final large tax bill. We work with, and I like to work with, younger, up and coming investors and property business owners, because we want to work with people who are just getting started, so we can work with them for years. But a lot of the people who come to us who have these large businesses, first of all, they don't understand the value of their business. So they might have £150,000 in the bank, but they've got a lovely management team, and their business works without them with a small tweak. But they just say, I'm just going to close the company, take the cash, close it down? Can you close the company down? And I think that's such a waste, because that was a family company. And as you say, they've got nobody to pass it on to. They don't have the energy. They may be ill, or they just want to relax for the last 10 years of their life. It's really sad. But it does also create a lot of opportunity, because a business will have to replace that business. That client base will need to be replaced. So if they do close that business, where are those clients going? So it's not all doom and gloom. These businesses are essentially being recycled, and it will always be that way. But the people who have been business owners for decades, they remember the good times. They remember the incentives, being able to take dividends tax-free, everything. So these tax thresholds we have now, they've been that way for many, many years. It's a silent tax. The £12,570 personal allowance, it's been very similar to that figure for a very long time. But the things you're selling now are so much more expensive through inflation. It's so easy to hit those figures. So you're paying tax on more and more and more of your income. So the conversations we're having, sadly, are if people do want to close their business, we just show them the most tax efficient way of doing it. But I do try to tell them that there's a lot more value here if you tweak what you're doing, if you remove yourself as the key person. Yeah. And landlords have been selling up for a very, very long time. Again, all of the new investors getting involved in the property market, they're usually just buying the stock from the old investors. The numbers still work. Everything works in property, but you need different, you need to understand if your limiting factor is time, capital, or experience. You can have buy-to-lets, HMOs, you can have the more trading businesses, deal sourcing, rent to rent, you can have commercial, you can have conversions. There's different tiers and different layers to it, but there's different risk levels, different capital, and different experience needed. So as long as somebody's fully aware of what is needed to get the project over the line, that's fine. But most of the time we're telling people that is it's not within your capability, because you're just getting started. People want to run before they can walk. So we've got lots of old landlords selling up. We've got lots of new investors getting into the market. Our job is to show them what is capable and safe, because property is a save point for me. And lots of the old business owners, they're closing down.
Well, when it comes to property, if capital wasn't the constraint, which route, avenue, strategy do you think is the most beneficial for long-term wealth?
Long-term wealth. So you should always be buying for cash flow regardless. Okay, yield is really important. If you have unlimited capital, I would buy somebody's experience. That's what I would be doing. So the time element, the way I invest, I outsource everything. I don't go to the properties. I don't have time to do that. I've got capital from trading businesses that goes into that. Experience, I understand it all because I've done it for a while, but I also don't want to be involved. So if I had, or somebody had unlimited capital, you want to partner up with, there's lots of good companies or people who have been doing this for 10, 20 years, and they will sit you down and show you 10 or 20 projects they've done. And you want to be it needs to be a physical, tangible, safe asset, which is property, that is immune to pretty much everything. So AI is going to create a lot of opportunities. It's going to replace jobs, create industries. Everybody needs a home. They always will. They always have. The UK is the safest property market for many geographical reasons. We're a tiny island. We're in the center. We're hard to get to. We're an economic power. And we've got a strong legal system. Once you purchase that property, you own it for generations. You don't need to worry about random events happening. And if it does happen in the UK, then it's probably happened everywhere else as well. So that's a much larger issue. So for long-term wealth, you want to buy for cash flow, because when you make an investment, you don't want to put any more capital in. You want to know that it pays you and itself forever. And rents go up every single year. Capital appreciation with freehold property is guaranteed, but you just don't know the timeline. But if your investment time horizon is long enough, so a decade or two, and another thing, if you plan to never sell, there's no tax on debt when you refinance, and you don't care what the market's doing, because if prices are going down, great, you're still acquiring. If prices are going up, great, you acquired already. So you remove the risk and variables that way. So depending on how much cash flow you want per month, and you've got unlimited capital, you would just look at some projects and say, okay, this HMOs are a good cash flowing strategy. Commercial's really good because you can get FRI leases. And once the business moves in, McDonald's, well, not McDonald's, but Starbucks might move in and give you a 10-year lease, and they do all the repairs, insurance, maintenance. And it's really easy. If a business defaults, it's really easy to get them out comparatively to a human, because humans have rights, as we should do, right? But businesses, if they default, you can get them out in 28 days. So it's safe.
Yeah.
It's less hassle.
What's your thoughts on the new renters reform and the increase in tenant rights? Like you said, I 100% believe people should have rights as humans, and have the right to have a roof over their head. But I think that, again, one of those disconnects in society, I think that they look at a landlord like you're a multimillionaire, and you can absorb this bit of pain that we're giving you, right? Where if you think about it, go back a couple of generations, or even one generation, really. My parents' generation, a lot of people in that generation, if they was fortunate enough to have one buy-to-let, that the mortgage that pays itself, the whole rich dad, poor dad method, and there's a bit of a retirement there for them, and there's a little tiny bit of passive income on the side, which isn't a lot, but for some people, that was their go-to investment strategy if they could make it happen. And of course, cost of capital was very low and a lot easier to access back then. Whereas now it's looked at completely different. It's like you're like the devil if you own some assets or you own property, right? So, but if you actually think about it, most of these people that own, if you look at people that aren't like portfolio landlords, even those are going to struggle if they have a couple of tenant voids or some tenant issues, because especially on buy-to-lets, the cash flow isn't amazing. But if you have like one or two buy-to-lets, one tenant decides I'm not paying, and that period of time is going to take them to get them out, and also you risk then the damage and the lack of care in the property because they understand the situation. I'm not saying everybody's like this, because I've heard some stories quite recently on LBC, which it makes you very sad, some of the situations people are going through, which is, for me, that's what the benefit system should be there for. You have someone that's at their job, they've lost their job, and all of a sudden now they're in a situation where things become hard. That's literally what it should be there for, right? But they make it hard for you. So what's your thoughts on this and the way this is going? Because it feels like it's getting even tighter and worse for especially like buy-to-let landlords, because the cash flow isn't great.
Great, sure. So if we look at the facts, most landlords own one or two properties, and they're usually accidental, which means they had a home, they bought a new home, and rather than sell it, or they couldn't sell it, they rented it out. That is a very precarious place to be. If you are investing in property, it is no longer something where you can just buy one or two and enjoy it, because it is a business. You're running a business. Even if you give it to a lettings agent, they're going to email you. You need to be treating it like a business. So what I say to people is, if you're doing buy-to-lets, you need a minimum of 5 to 6, minimum, okay? Because then if somebody doesn't pay the rent, and we're all human, these things will happen over it's probability. I've never had that happen to me. It will happen in the future. It's guaranteed. But you need to make sure that your buffer, so if you've got 5 to 6 buy-to-lets and there's an issue with one of them, you're still profitable. If you're doing it with HMOs, you need two, depending on the value, 2 HMOs, potentially 3 if they're more cheap. But you need to run this as a business, and you need a very clear-cut goal of, what do I want from it? So if it's just a pension, then if you buy a piece of land and hold it for 30 years, you'll make some money. Great. You want to be treating it from a business perspective, where you say, okay, I need £2,000 a month. How many properties do I need? 5 to 6 buy-to-lets will do that over a 4 or 5 year span. As long as it's treated as a business, it's okay. The Renters Reform Bill is pushing lots of people out of the market. We lost 2 million rental homes. I'm not sure the time span. I think it was over the last 48 months, 2 million. What has that done? That has pushed rents up. That has increased yields. So interest rates went up, rents were the same, people sold, rents have gone up. It's back to where it was from a yield perspective. So it ebbs and flows. So the key thing here is you need a long-term approach to this. There's no point in buying a buy-to-let for 3 or 4 years. You need to be planning to hold it long term. And how much capital do you have? Because buy to let does work if you leave more capital in. It's that simple. So it's very systemized, simple. Give it to a letting agent. If you have a 50% loan to value, well, you get some good cash flow. Each property should be making a minimum of £350 net per month. Okay, with a mortgage. That is achievable. It's not achievable in the south. It's not achievable in the Midlands anymore, but there's lots of places up north. And property is about the people. So if you have reliable people and I'm speaking from somebody who lives in the south, if you live in the north, it's even easier. But if you have reliable people to find the property, refurb the property, because the refurb is where you make this very tax efficient. If you buy a cash flowing asset from day one, well, you'll be paying tax pretty soon. If you buy a £100,000 property for 60K, you've got your stamp duty, you've got your fees. If you spend 25 grand on it, but you're bringing that property back to life, none of this is capital expenditure. Damp work, painting, replacing the bathroom, replacing the kitchen. A lot of that is a revenue expense, which means it puts your company into a loss, which means there's very little corporation tax to pay. It's called momentum investing. So as long as you keep the momentum as you're investing, there's no corporation tax to pay. Of course, there is corporation tax to pay at the end when you slow down, but it allows you to reinvest a lot more of those profits. So this is what I mean by it has to be treated as a business. And you need to speak to somebody who knows what they're doing, because some people, and it's crazy. Some people come to me and they say, oh, I've just purchased a buy to let in my own name. And I think if you had just YouTubed that, there's a million videos saying don't do it. Like that would have piqued your interest to maybe go and explore it. But people come to us and say, just completed on this. It's an off plan. It's in my own name. I'm making 70 grand in my job. What tax do I need to pay? And I think that's the sentence. It's going to be very hard for you to now potentially release this property. So business owners work backwards. Yeah. So if you're going to invest in property, you need to say, what's the goal? And maybe it's easy for me to say this because this is how I approach things. And most people who invest in property aren't business owners. They're looking for the pension. But you need somebody to say, okay, this is the plan. This is the cash flow. This is how much capital I have. This is the how much time I want to be invested. Then what do I need to do? The Renters Reform Bill has made rents go up. It's reduced the amount of people entering the market, which means there's a lot more opportunity. It's made a lot of the larger landlords who had property portfolios in their own name sell. Property prices aren't going up currently in that demographic where those properties are. So it's a really good opportunity. But what will happen, and this is my prediction, in 2 years' time, when the UK realize that everybody still needs a home, all of these people are still renting, the institutions now are building to rent. Lloyd's, BlackRock, all of these massive corporations are now either trying to buy lots of properties to rent, or they're building 50,000 homes, and rather than selling them, they're renting them. They will become the new comparables. They are new builds to rent. So when you look in an area and your rent is £750, and next door you've got a £975 property, but at the end of the day, it's still a 3-bed semi-detached property 2 roads down, that is a comparable. So currently they're not looked at as comparables because they maybe have a gym in and they've got a communal area. They will be the comparables. So for the people who want to do this long term and stay with it, it's going to become a lot more lucrative. But this is why the capital always needs to be moving.
Yeah. And you mentioned there something I think is really important, whereas I think people do tend to go into property initially and they don't look at it as a business. They look at it as just property investing. And they're building a portfolio that I just don't think they realize that they're building a business, So what reporting cadence do you recommend for your clients that, they are building a portfolio? They do have 4, 5, 6, maybe 10 buy-to-lets. What sort of things you tell them to do to make sure they have full visibility of what's going on, so they have the data to make more informed decisions?
Yeah. So we work very personally with everybody, all of the investors have my number. So lots of the time, this is just a phone conversation. Initially, you don't need reporting. A single property will probably have 20 or 30 transactions. It's less transactions, but very important transactions. And it's more about what you're purchasing rather than having visibility. Once you get to 5 or 6 properties, you should have quarterly management reports. just so you know how much profit you're making per quarter. But a lot of this does come down to a philosophy. The way I look at things is profit per portfolio. But I've got friends who have got large portfolios who look at profit per property. And sometimes they're looking to release properties that aren't working too well. Everything I buy, I plan to keep forever. I've never sold a property because I just look at everything as a whole. If you take on 50 clients, 40 of them will be great, 5 of them will be okay, 2 of them will just be a headache. It's a service-based business. It's the same with selling a product. If you sell 100 products, there'll be a default rate. 5 of those products break in transit. With property, if you buy 10 properties, there'll be 1 property that is underperforming compared to the others. So if you want to release properties, and you also have to think about the value. So I'm thinking about buy-to-lets here. If you want to release properties, you need to know the numbers per property on an ongoing basis, but then you've got bookkeeping costs unless you do it yourself. More expensive properties, absolutely, you should look. If a £500,000 property is underperforming, get that capital back and redeploy it. But with buy-to-lets, it's a different strategy because it's the foundation of any portfolio. The lenders want to see that you can manage a buy-to-let before they give you an HMO mortgage. Once you've got the HMO, they'll be like, oh, you want a commercial mortgage for a warehouse? That's okay because we can see that you're responsible and you understand the investment and you understand. So you can't run before you can walk. You have to go through the steps if you want to have the smallest finance costs. Yeah. But my thing for everybody is, because 80% of people need to keep it simple, keep it as simple as possible and then add complexity if you want to. But don't go in and try and buy a commercial property if you've never invested before, you've got a PAYE job and you don't have a buffer of cash. Go and buy that cheap buy-to-let. So you can go through the process, you can go through the solicitors, the stamp duty, renting it out, the letting agent. Do you like it? Do you like the fact that there's an asset that you can't see or touch and it's 200 miles away? That stresses some people out and they don't like it and they think, oh, I don't want another one. So rather than going and putting your £500,000 and £600,000 cash into a property, and then it's a much larger issue, you need to work out if this is for you. Because you can get dividend stocks that go up, you can get index funds, gold, crypto is extremely speculative, but some people love it, buying businesses. There's many things to invest in. But I like property, so I work with property people. But it's not the only thing.
Yeah, I think you made 2 big takeaways I've got from this conversation, which I think shows the sort of the investor mindset in you. And I think that anyone that's more investor-driven, investor-focused, they're very much big on risk appetite and time horizon. And that's come up so many times in this conversation. And I think that the 2 things that most like newbies going into any investment or asset class get wrong. They want everything very quickly, and they think that there's not a lot of risk associated with those investors, or they don't expect things to go wrong. So I think that if anyone can take anything away from this conversation, is those 2 things there. I think the time horizon is always going to be longer than you initially want it to be or you expect. So you're better off taking the longer one in general. And your risk appetite needs to sit well with yourself. All of our risk tolerances are going to be very different. And you need to really work out and have a conversation with yourself to work out what you would and wouldn't be comfortable with. What's the worst case scenario? And try and model that in your mind. The last question from me today, John. At the start, you mentioned a few comments around entrepreneur's curse, moving the goalposts, which, every entrepreneur does the same. It is the entrepreneur's curse. You look at shiny objects, or you get somewhere and you want to do more. With your journey so far, you've been in this for a long time. If a newbie's coming into this today, what books have you read that has been really valuable? And the reason why I'm asking this is because we're now in a time where someone can type in one of the LLMs and say, I don't know, summarize this book for me, give me the big, the best bullet points. This is what I'm looking to get out of this or extract from this. And I feel that and there is a lot of filler in books, I totally understand. But there's certain books that you can't take your head out of when you're first learning about entrepreneurship in general, and you're going through that growth process, and we're forever growing, right? What are the books, the 3 books that you have a meal to get your head out of, and you're glad you read them and didn't summarize them on ChatGPT?
Yeah. Perfect. Okay, so I'll start with the entrepreneur book. Most successful people have teams, a team of 2 usually. Warren Buffett is one of the best investors of all time, if not the best. But he had a business partner called Charlie Munger. And Charlie Munger was less in the limelight, but he is a fantastic mind. He's a polymath. He did everything. He wrote a book called Poor Charlie's Almanac, and it's fantastic. He talks about psychology, investing, life, marriage, everything that actually comes with the package of being a business owner. It's not just the business, it's everything around. Poor Charlie's Almanac is one of the best books ever written on that. And I like a lot of philosophy, so I'm going to go with the Stoics. My number one book that I've reread, and I will always reread, is Meditations by Marcus Aurelius, which is, he was the final Stoic philosopher of Rome, and they are his writings. Amazing. And Seneca on the shortness of life, because, not to be cliche, but time is the only asset. And as I said, there's not too many investment horizons we have. You have to work out how long you want to do this for. And if you say a project might take 5 years, that's 5 projects. That's not a lot. So you need to make sure that what you're saying yes to is the correct thing.
Yeah, I love it. I love it. And on the back of what you just said there, I can't remember who it was, but I seen one of a short form content, and someone was saying, you get X amount of summers. Think about how many summers you have left. I can't remember the amount of time, but when you think about it, if you look at the average life expectancy, which I know we could have a conversation about that, and how maybe we get to choose when we die, if we live for another 15 years because of some of the technology that's coming out. But if you think about the average life expectancy and how long you actually have from the time you become you get to a stage in your life where you're like, well, now I can start to do X, Y, and Z. You don't actually get too long, right? So, and that goes for, I love that you mentioned Charlie's book, because the entrepreneurship and business comes with all of those things. You can't, if you have a family, yes, you can be the driving force of your family, but there's another part of life. And, I know the word balance is very hard to find. And, I know that it's hard to have balance as an entrepreneur, and especially if you focus on it, it can be quite unproductive. But you just work things out, right? You just you make it work. And so I love that you mentioned that book as well, because I think there's so many more things that come with just sat behind a laptop or sat at your desk and just powering away every single day. So, John, really appreciate your time.
Thank you.
Glad we managed to make this happen, and I'm sure we'll catch up soon.
Perfect. Take care. Bye, Dee.
Cheers.